Hi, everybody. Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania, with the weekly QCast update. And here's what we've got. It's obviously the first part of the month, first part of October, and we're going to be talking about our strategy update. And what is it all about? It's all about the Fed. And I'm using kind of an old cartoon here from Hedge Eye, but it really makes a point about how the Fed has really dominated the news since August. Now, you got to remember, the Federal Reserve has a mandate of full employment and controlling inflation. And with inflation supposedly running around 8%, I'm going to show you some data on why we think it's coming down. The Fed has been turning the screws tighter on raising short-term interest rates, and that's been really causing a consternation in the stock market. So much so that the S&P 500 lost 9.3% for the month of September. This is the worst monthly loss since March of 2020. It was not pretty, but lo and behold, literally the first 2 days in October, when the calendar changed over, we saw back-to-back 3% rises in the averages, a very sharp rally. Now, we think there's some positivity ahead. The only other year that you saw 4 consecutive declines, quarterly declines in the stock market, was 2008 during the global financial crisis. We are nowhere near the global financial crisis at this point. And my message today is that we think the fourth quarter is going to be much better than what people realize, and that the surprise is on the upside. And let me walk you through this. Now, one of the other things that's been dominating the headlines has been increasing interest rates. Now, the Fed only controls short-term interest rates. They can make the Fed funds rate move up and down, and they've been slowly turning the heat up and raising Fed funds rates 3/4 of a point at their last couple of Fed meetings. The question is the next Fed meeting they're going to raise 3/4 of a point or not? But what ends up happening is that on the long end of the curve, or longer term bonds, you then see those longer term yields get dragged up. Well, what does that mean? You can see by my chart here that this is the worst year ever in the bond market. Many intermediate to long-term bond funds, which many conservative investors hold, are down anywhere from 14 to 18% this year. Now, the good news is any money you put to work right now in the bond market, you're getting a much better interest rate than you were even 3 to 6 months ago. So what we're trying to tell clients out there is that if you're scared, buy some short-term bank CDs. Right now, short-term bank CDs, 3-month bank CDs are paying 3 3/4 to almost 4% for a 3-month bank CD. If you're not too scared, you should be buying tax-free bonds right now. And if you're really looking out longer term, you should be buying dividend stocks, which you can see by my chart here that the 10-year Treasury hit 4% in September. That was one of the reasons why the stock market sold off rapidly, because as bond yields go higher, stocks then become less attractive because there is another alternative. And what we mean by that is a couple of years ago when stocks were racing up, there was the acronym called TINA. There is no other alternative out there. And that meant everybody was just getting rid of their bonds and just buying stocks and stocks and more stocks. Well, now if you have, quote, risk-free rates of 3.5% to 4%, those are competing with stocks. And as interest rates went up in the month of September, we saw the stock market sell off. But the real point that we want to make is that everybody's focused on inflation. And you got to remember, by the time this video is coming out, in about the middle of October, we're going to get the CPI for September, the Consumer Price Index, which is a measure of inflation. Now, that's been running pretty hot at about 8% so far this year on an annualized basis. But what we're trying to show here is that inflation expectations are coming down. We're seeing used car prices coming down. We're seeing housing prices coming down. We're seeing energy prices coming down. Many of the components that go into measuring inflation have rolled over and they are coming down. And what this chart shows here is that inflation expectations are coming down. So what does that mean? That means if inflation expectations are coming down, sooner rather than later, the Fed will be able to stop raising interest rates to try and control inflation. And in fact, maybe at some point, they could actually stop raising rates at any point and maybe even lower them to make sure the economy stays on an even keel. So we think this is a very important slide. Inflation expectations are rolling over. We think that bodes well as far as what the Fed's going to be doing in the next 6 months. And we think that's going to help, obviously, equities and bonds longer term. So the other point that we want to make is that there is absolutely nobody out there bullish at this particular time. I get this chart every week from Bank of America, and they put out their bull bear indicator. And you can see that the last time this chart was in the super positive range was February of 2021, when it was at 7.7 on their scale to 10. You can see that the latest on this bull bear indicator is that there are 0 bulls out there, and this indicator has been slammed for the last 2 weeks. Nobody is bullish on the stock market. Nobody is bullish on the bond market. So what you have to be is you have to be a contrarian. If everybody's negative about the U.S. economy, about the war overseas, about what's happening with the elections, et cetera, that's setting up for days like we had in the first 2 days of October, where you literally had a 3% rally on a Monday and Tuesday, the first 2 days in October. So again, we believe that the surprise is on the upside because everybody is super negative on what's happening out there. So just to sum it up here for our first of the month update, stock market measured by the S&P 500, the Dow Jones Industrial Average, and the NASDAQ, we have had 3 down quarters in a row. The good news is we are also entering a statistically strong period for stocks from October through May. If you bisect the stock market's monthly returns, the next 6 months are statistically the strongest period for equities out there. Now, the other thing that we want to point out is that we run a tactical account that goes from stocks to bonds to cash. And our tactical account started to get into the stock market. It was all in cash at the beginning of the year. In May, it started to get into the stock market. In June, it got more into the stock market. 2 weeks ago, our risk indicators were so compressed that our tactical account is now 75% stocks, 25% short-term fixed income, giving us another buy signal on the U.S. equity markets at this time. So that's the first of our month update. If you want to talk to me about this, feel free to give our office a call, 484-350-3301, or better yet, if you download my app by texting Chris E, C-H-R-I-S-E to 36260, you can watch videos like this. We also post other videos with very timely topics. We recently did a Medicare webinar that you might want to take a look at. But again, thanks for watching, and we'll talk to you soon.